Welcome, everybody. So the last 5 or 6 years have been pretty interesting. We've had recessions, declining student enrollments. We've had aging facilities, declining capital and operating budgets. And we thought, as we were starting to prepare this, how do you deal with all these kinds of issues that are challenging your campuses? So our session today is designed to bring some perspective and insight on these issues, and in particular, to start thinking about the interrelationships of capital needs on campuses with your financial capacities and how to manage your balance sheets. Ultimately, we want to relate that to a couple of case studies to show how people have actually dealt with these issues in pretty innovative and interesting ways. My name's David Kadamus. I'm the president of Sightlines, and let me introduce you to the rest of the panel. David Hansen is the CFO at Virginia Commonwealth University. Craig Woody, next to him, is the CFO at University of Denver. And then Lee White is the executive vice president of GK Ball. Each of those folks will be adding components to this session. I'm going to try to provide Sightlines' perspective in terms of the data that we've gathered across the country regarding national trends on facilities and the capital dynamics. Lee will then, I'll hand it off to him, who will focus on the financial dynamics and the analysis that we've tried to create some correlation between bond ratings, debt coverage ratios, and capital needs. And then we'll get into the VCU and Denver case study. Some national trends. Just as a background, Sightlines, we work with close to 400 campuses across the country. Our database is over 1.2 billion square feet of space, and we gather annually between 16 and 17 billion dollars of operating capital budgets from all the campuses. We actually visit each of these campuses to collect the data and actually define these trends. Here's a few things that we've been discovering as we started looking at our database over the last few years. What a surprise, campuses are getting older. That's no big news there, but I do think that the whole profile is pretty interesting. As we start sorting the public institutions versus the private institutions, we found that in general, the private institutions are a little younger, and this is just the campus space 25 to 50 and 50 and above. So all the rest of the percentages are all the buildings under 25 years old. I think the fascinating thing here takeaway is that although the private campuses are a little younger, they have a greater percentage of very old facilities. So there's a barbelling effect happening on those campuses. It's also interesting to know that if you don't know the age on your campus, you're going to be challenged in terms of coming up with some capital strategies and the ability to forecast your capital needs. So we think that is a major trend that campuses have to start thinking about, and most CFOs don't have a strong understanding of that profile. Much like any other portfolio, we think your investment strategies are going to have to change depending on the age and era of your facilities. So we sorted the space again in another way. We sort the space by construction era. And what struck me here is, in a very fascinating way, is that there were two major periods of construction for higher ed, from 1960 to 1975, where approximately 35% of all the space was built. And then again, since 1995 to date, another 32%. In addition, we have a lot of infrastructure that's all in the 50 to 60 plus years old age category. Over the next 10 years, we will be seeing those three factors tying together. Those 60s buildings that are going to need major renovations and modernization, the buildings that were built in the last 20 years that need to be sustained as your new buildings. They're not so new anymore, but we need to keep them looking new. So there's major sense of repairs and upgrades, and the whole campus infrastructure. Those capital needs are simultaneously happening as our resources continue to diminish across the university. So how do we start managing and driving that forward? Just so you see, 2008 and 2009 was a major threshold. After the recession in 2010, we saw a significant drop-off in capital spending across all segments of higher education. The drop was a little bit different, though, between the publics and the privates. The drop was a little bit deeper in the private side than on the public side, but it recovered more. But we're still not to the 2009 spending levels. Just let me explain a moment on this chart. The dark blue are the monies that are coming out of the annual operating budgets versus the light blue are one-time monies coming from bonds or gifts or government appropriations, those types of things. When we look at that, the trends are important to recognize. That most campuses did not reduce their annual capital budgets, but they really took it out of their one-time money. Their one-time capacity is where the major thresholds were taken. In the private side, the one-time expenditures have grown at a much faster rate than on the public side. And basically the cuts from 2009 to 2010 have been pretty much leveled, and they haven't really recovered much on the public side. So it's an interesting challenge of where is the money coming from, because state governments are just not coming to the table with lots of resources for university buildings. What a surprise. Our backlogs have grown, and they've grown pretty significantly in the last 5-6 years. In fact, they're up over 16-17%. So in 5 years, so you're growing at 3 to 4% compounded rate. You start thinking about that as an escalation level, and that becomes a significant challenge for the management of your campus facilities. So what has campuses done? Well, it's interesting. They've changed their philosophy on how they're doing work. Even though the dollars are less, they've tended to shift money towards those mechanical and envelope kinds of issues, the exteriors of the buildings, the roofs, the chillers, the boilers, the electrical systems. We've seen that shift pretty consistent across the country, both publics and privates. So, you know, back in 2007, it was about 50-50. Today it's, you know, 35-65, almost on a split. So that's a very substantive shift in just a couple years. So people are starting to recognize that those mechanical systems that are in those 60s buildings and those 70s buildings are just driving, and you have to start addressing them to sustain the reliability and support program. So we're seeing that kind of shift, and so when you start thinking about, I was sitting in an earlier session today on debt and risk, and you know, these were the risks. People are shifting their project selection to abate the risk profile on the campuses, and that's an important recognition and plan that's moved forward. Additionally, we think that there's some prediction tools that you want to start to bring into play here that can help start managing, and we start developing these and working with a lot of campuses. The dark blue and light blue lines are the same lines that we've seen there. The red zone there between the two red dotted lines is what we see as the target spending rate that you should be setting aside or spending on an annual basis. The yellow line is actually your predictive line that says what's the profile that you need. Well, it's interesting to know when your peaks of spending need to occur, but conversely, if you understand the mix under those peaks, you get a bit of a different story. So in reality, when you look at this chart, I tend to look at it that when you're out around 2015 at this particular campus, even though that's a relatively low capital spend profile, it's the highest mechanical need on a percentage basis. Potentially, that's the highest risk year that's out there. So not only do you need to understand as you're playing out forward and start planning for your resources, the moves going forward on the total needs, you need to understand what the profile is for the mix of spending. So not only is it the total dollars that you have to start planning for, and our goal is to help campuses anticipate those expenditures, you know, in a 4 to 5 years in advance, but more importantly, to understand the mix of needs that are out there and what kind of pressures that would create.